These talks are brought to you by Claritax Books and are proudly sponsored by Six Forward Capital Allowances.
Hi, and welcome back to this second in our series of talks on capital allowances. Last week's video was very much an introduction, and so today we're going to start looking more closely at plant and machinery allowances. As I previously mentioned, these allowances are covered in Part 2 of the Capital Allowances Act. Part 2 opens with Section 11, and this is where we find the key starting point for determining whether a person can claim plant and machinery allowances or not. So what does Section 11 tell us? It says that plant and machinery allowances are available if a person carries on a qualifying activity and incurs qualifying expenditure. On the face of it, what could be simpler? Allowances will be due if we can tick two boxes. Do we have a qualifying activity? And do we have qualifying expenditure? So let's begin by looking at what constitutes a qualifying activity. The legislation, Section 15, provides a long list of these activities. They include trades, various types of property business, including furnished holiday lettings, professions or vocations, various mining concerns and transport undertakings, managing the investments of a company with investment business, special leasing of plant and machinery, and employments or offices. Now that's quite a long list, but in reality we can simplify it into trades, professions or vocations, a variety of property businesses, special leasing, and various other categories. Special leasing, by the way, refers to the hiring out of plant or machinery otherwise than in the course of any other qualifying activity. In practice, most claims for plant and machinery allowances are made for trades and for property businesses. Usually, we do not need to worry too much about the nature of the qualifying activity. But the distinctions can be important, so in cases of doubt, we need to refer back to Section 15. By way of an example, we can think about plant or machinery in a dwelling house. It's widely known that plant or machinery allowances can't normally be claimed in a domestic property. That's Section 35. But in fact, that restriction only applies for property businesses and for special leasing. It doesn't apply for trades or for furnished holiday lettings. For this reason, knowing the technical distinction between an ordinary property business and a furnished holiday lettings business can make all the difference. Another key point to remember is that allowances are given separately for each different qualifying activity. So if the same person carries on both a trade and a property business, the allowances for those two elements must be kept separate. Now that's been a quick look at qualifying activities, but I'd also like to make a start on the much bigger issue of qualifying expenditure. It will take us several weeks to go over this topic, but just to begin, we need to go back to Section 11. Section 11.4 provides the general rule as to what constitutes qualifying expenditure. It must be capital expenditure on the provision of plant or machinery. It must be incurred wholly or partly for the purposes of the qualifying activity that is carried on by the person incurring the expenditure. And the person incurring that expenditure must own the plant and machinery as a result of incurring it. Now that wording is packed with significance, and we'll delve into it later, but crucially this general rule is affected by other provisions of the Act, and in particular by Chapter 3. Chapter 3 includes sections 21 to 23, with the various lists A, B, and C, and that is what we're going to focus on next, starting from next week. So thank you for watching. Please do get in touch if you have any queries at all, and I look forward to seeing you again in a week's time. I'm Ray Chidell. This talk was brought to you by Claritax Books and sponsored by Six Forward, an independent property tax consultancy working with accountants to enhance capital allowances for their clients.